The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you. You're listening to the Telltale's Weekend Update. I'm Ava Cabot.
And I'm Marcus Graham, the Cash Flow Desk.
Quick note before we start. The show is produced entirely with AI tools, and both voices you're hearing are AI generated. Send feedback through the Substack. This was the week the AI build stopped being a guide and started being a cash flow statement. Three of the largest companies on Earth reported inside 72 hours, and the market handed out three completely different grades for what looks from the outside like the same behavior. On Wednesday's show, episode 2631, Hunt, Jason, and Mike spent their time on open weights versus closed labs and where the value goes once model economics commoditize. This week, the market answered a much narrower version of that question with money. Cash flow did the grading. Microsoft just got a standing ovation for spending money. Azure crossed $100 billion of revenue in a single fiscal year for the first time. Fourth quarter earnings, $4.74 adjusted, up 23%. The stock jumped 15% on it, and buried underneath the applause, Microsoft Cloud gross margin fell to 68%, and the company's own explanation was the cost of scaling AI infrastructure and the growing usage of AI features. So the build is already in the margin line. On page 1 of the memo, Apple and Microsoft printed inside 2 days of each other, and only one of them got that reception. Marcus, who actually got paid this week.
Microsoft got paid on the income statement and billed on the cash flow statement, and the market only graded the first one. Going into this print, the memo had them at about 38 times trailing free cash flow on roughly $76 billion of trailing free cash flow that was down about 21% year over year. That's Q3 10Q confirmed. We re-anchor when the 10K files. Azure crossing that line is real money. So is the cash disappearing into the build. What I'd watch on the next print is whether the revenue line starts catching the CapEx line, or whether we're still calling this a growth story 2 years from now.
Meta spent the same kind of money and got the opposite grade. Revenue over $60 billion, up 28%. Second quarter free cash flow down 91%. The stock fell 8%, extending a record losing streak. And on the call, Mark Zuckerberg said Meta is, quote, getting a lot of offers for compute at a significant premium over what the company paid. Free cash flow down 91%, and the pitch is that people would like to rent his GPUs. There was also a $2.4 billion charge for legal proceedings and a $14 billion data center venture with BlackRock. Marcus, what did that $14 billion buy?
It bought the ability to keep building without the whole bill landing on Meta's own cash flow statement. That is what a joint venture is for. Going into this, print the memo had Meta at about 30 times trailing free cash flow on about $50 billion of trailing free cash flow that was still growing 22%. Q1 10Q confirmed. We re-anchor when the Q2 10Q files. So the trailing picture going in was fine. The quarter is what broke, and the move in the stock says the market has decided the quarter is the new trend rather than the exception. I'd weight that as more likely right than wrong, but it is one quarter, and I'd hold that view loosely until the next one confirms it.
Which brings us to the control group. Apple didn't build anything and got marked down anyway. The June quarter print beat, with net sales around $109 billion and iPhone sales up 22% year over year. It was Tim Cook's last earnings call as CEO, with the stock at a record. He hands the job to John Ternus on September 1st and becomes executive chairman. And then Apple guided the September quarter to 9 to 11% revenue growth, below where the street was, and blamed supply constraints. Goldman Sachs cut its price target to $360 on the guide. Morgan Stanley also moved to $360, working off calendar 2027 earnings of $10.30 a share. Two houses, two different models, the same number. Marcus, this one's for you.
Apple is the counterexample that makes the rest of the week legible. Going into this print, the memo had Apple at about 37 times trailing free cash flow on trailing capex of roughly $11 billion, which is a fraction of hyperscaler scale, with free cash flow growing 28%. FQ2 10Q confirmed. We re-anchor when the FQ3 10Q files. So here's the week in one line. The market paid for the build where the revenue already showed up. Build it where it hasn't. and then marked Apple down for something else entirely, parts it can't get. That's a supply problem, not a valuation problem, and supply problems resolve on a different clock.
3 companies, 1 build, 3 verdicts. 3. 2 pharmaceutical deals landed this week, both on page 15 of the memo, and they are the same argument as the hyperscalers, just at a deal table instead of an earnings call. One company had the cash flow to write the biggest check in its history. The other one has cash flow good enough that somebody wants to buy it, and not enough scale to make that go away. Vertex agreed to acquire Crinetics Pharmaceuticals for $10 billion in cash, $85 a share, the largest acquisition Vertex has ever made. It also signed a collaboration with AbCellera on next-generation T-cell engagers, $28 million upfront, and Vertex reports Monday. Meanwhile, Curium is in advanced talks to acquire Lantheus for about $7 billion, a deal that could be announced within days. And 2 days after that report landed, B. Riley raised its price target on Lantheus to $129 from $97. Marcus, which side of that table would you rather be on?
Lantheus is the more interesting one because the sell side responded to a takeover report by marking the company up. That does not usually happen when the bid is generous. The memo has Lantheus at about 17 times trailing free cash flow at roughly a 6% free cash flow yield with effectively no net debt. Q1 10Q confirmed. A debt-free radiopharmaceutical business throwing off that kind of yield is not a distressed seller. What I'd watch over the next 2 weeks is whether the board treats that number as a floor or a ceiling, and whether a second name shows up before anything gets signed.
An offer the analysts think is too low. Imagine that.
Vertex is on the other side of that trade because its cash flow bought it the option to be. The memo has Vertex at about 30 times trailing free cash flow on about 3.7 billion of trailing free cash flow, up roughly 66% year over year. Q1 10Q confirmed. That is what lets you write an all-cash check of that size without asking anyone's permission. The honest caveat is that writing the check is the easy part. This is the largest deal Vertex has ever done, which means the integration is unproven, and in the meantime, the existing franchise is funding all of it. Monday's print won't tell you anything about the acquisition. It'll tell you whether the base business is still carrying the load.
And look at what Vertex is assembling on top of the acquisition. That AbCellera collaboration is aimed at multispecific T-cell engagers for autoimmune disease and other conditions. So inside 1 week, a $10 billion company purchase and a $28 million science partnership. Very different price tags, same instinct. Lantheus, on the other side of the table, is a radiopharmaceutical business. Targeted drugs, narrow patient populations, and specialty sales forces that are expensive to build and hard to replace once you have one.
Which is why the buy versus build math has gone so lopsided. Building a specialty commercial organization takes years you do not get back, so a company with real free cash flow buys one instead, and the price of that shortcut gets set by whoever else has cash that week. Vertex had it. Curium apparently has it. Lantheus is the one being priced. Same mechanism we just watched in the hyperscalers. The currency is a sales force instead of a data center. Same page, same week, and what decided which side of the table each one sat on was how much cash each business throws off. What I'd watch from here is that Lantheus number. If 7 billion moves, it tells you the cash flow was worth more than the bid assumed.
2 companies, 1 page of the memo. The cash flow statement wrote the outcome for both. Rapid fire, 3 names, then the forward week. The most important company in the AI build had one of its worst weeks of the year, and it didn't report anything. A Shanghai-based, state-backed Chinese company has begun mass-producing deep ultraviolet immersion lithography equipment the machine's ASML has effectively had to itself, reportedly after absorbing staff from a Huawei-backed startup. The shares slid to their lowest level since early June. Bank of America says investors are overreacting to the China threat. Maybe. ASML also posted 5.6 billion euros of net bookings in mid-2026 on strong demand for its high-NA EUV systems. So the order book is fine and the moat is the open question. Those are different problems on very different timelines. Intel, also on page 3, posted its fastest revenue growth in 15 years and announced 24,000 job cuts inside the same 10 days. Second quarter revenue up 25% to $16.1 billion, the strongest growth since the third quarter of 2011. The forward guide topped estimates on data center strength. Intel also committed to mass production of its 14A node in 2028, and CEO Justin Hotard is cutting 24,000 jobs as part of a restructuring. Growth and a restructuring in the same breath usually means the growth isn't coming from where the headcount is, and the AI build showed up in an oil major's earnings. Chevron reported second quarter earnings of $12.1 billion, $6.11 a share diluted, up 384% from a year ago. Chevron also signed a 20-year power purchase agreement with Microsoft, supplying 2.67 gigawatts of behind-the-meter power to a West Texas data center. 20 years behind the meter. That is a hyperscaler deciding it would rather buy the gas than wait on the grid. And CEO Eimear Bonner said she expects fuel-making margins to stay high for as long as energy markets remain, quote, under stress. Chevron also confirmed the Caspian Pipeline Consortium is flowing again with ships loading this week and signed preliminary agreements to advance discussions on Iraq's West Qurna 2 and Nasiriyah fields. A quadrupled quarter, a 20-year utility contract, and 2 new frontiers, all in one press cycle. The forward week is heavy. Palantir and Vertex report Monday. AMD, Caterpillar, Pfizer, Spotify, and TransDigm on Tuesday. Wednesday brings Disney, Eli Lilly, Uber, Occidental, and Magnolia, which just agreed to buy Wildfire Energy for about $4 billion and priced a $1.1 billion stock offering the same week. And Thursday, ConocoPhillips, Cheniere, Airbnb, and Lentheus, which may or may not still be an independent company by the time it reports. That's the show. Wall Street's consensus on the AI trade this week. Microsoft's spending is disciplined and Meta's is reckless. Same build, same bill. The only real difference is that one of them can already show you the invoice it sent. Cash flow did the grading this week. Microsoft got paid for the spending. Meta got billed for it. Apple got marked down for parts it couldn't get. And over on page 15, the company with the cash flow wrote the check while the company with less of it got an offer. Next week, the forward calendar does the talking. Download the cash flow memo at telltales.us. Hunt, Jason, and Mike are back Wednesday on episode 2632. I'm Ava Cabot. Have a good weekend. The views expressed on this podcast are the host alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security, nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the host nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, express or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The host and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future, and may or may not hold positions in the securities mentioned.